Hello, everybody. Welcome to Intermediate Accounting 17th edition video solution walkthrough. This is for exercise 1611. The textbook authors are Don Kiso, Jerry Weingett, and Terry Warfield. The question used in this presentation is copyright 2019 by John Wiley and Sons. Wiley, all rights are reserved. This is for educational purposes only. The video may not be distributed or redistributed without the express permission of Wiley. The solution presentation is copyright 2019 through 2022 by Bennett Tchaikovsky. All rights are reserved. The opinions contained within this presentation are those of Bennett Tchaikovsky and not the authors of the textbook or of Wiley. Okay, let's have some accounting fun. Right over here. So Titania, granted, I'm not sure if I pronounced that correct, but please someone correct me if I didn't do that right. Granted stock options to officers and key employees for the purchase of 20,000 shares of the company's $10 par value common stock at 25 per share. The options were exercisable within a 5-year period beginning on January 1st, 2023 by grantees still in the employ of the company and expiring on December 31st, 2027. The service period for this award is 2 years. And assume that the fair value option pricing model determines total compensation expense to be $350. Now, if you go back and look at my video solution for exercise 1610, I'll show you how that's actually, or show you a link to a video where you can see how that's gone through and computed. So we have a couple different things happening. On April 1st, 2022, 2,000 options were terminated when the employees resigned from the company. The market price of the common stock was $35 per share on this date. On March 31st, 2023, 12,000 options were exercised when the market price was $40 per share. So the first thing we have to do is we're being asked to do journal entries to record the issuance of the stock options, the termination of the stock options, the exercise of the stock options, and changes to compensation expense for the years ended December 31st, 2021, 22, and 23. When the stock options are actually issued, we're not going to make a journal entry, right? Because the employees actually have to serve the time. So that sounds like public accounting. So 12/31/21, because the service obligation is going to be for 2 years, we're going to record stock compensation expense. And this is going to be 350,000 divided by 2, or 175,000 additional paid in capital stock options. Now, on April 1st, right over here, on April 1st, we're not fooling today, my dad humor for the moment, 2,000 options were terminated when employees resigned from the company. What the solution key shows, and I've kind of come to somewhat agree with this, is what we're going to do is we're going to reverse a portion of what we've already recognized as stock compensation expense. Since there's a forfeiture, meaning that they're going to give up any right into the stock option, what we're going to want to go through and do is go ahead and reverse out part of this entry. So if my stock compensation expense for the prior period was 175, and if 2,000 options of the 20,000 options so this 175,000 was related to 20,000 options. So the amount of stock compensation expense I'm going to go through and kind of reverse out is going to be 17.5. So here I'm going to debit additional paid in capital stock options for 17.5. I'm going to go over here and credit stock compensation expense for 17.5 to record forfeiture of stock options. Now, one of the problems with this is that if we look at the matching principle, what we should have done is that if these employees would have resigned earlier, what we should have done is obviously we want to try to match it in the right period. But given that there's that forfeiture language, this is how we're going through and doing it, or this is what the book solution is suggesting. I don't necessarily disagree with it. If it were me, I probably would end up leaving it alone rather than reduce stock than crediting stock compensation expense. But I do understand the logic behind it. I just don't necessarily, I'm not necessarily fully comfortable with it, but I understand where they're coming from. But I could be wrong on this. And if I am wrong, I would appreciate if someone could reach out to me and show me the light. So what about for 12/31/22? Well, we know that stock compensation expense for all of the options, it was 175,000. However, as right now, not all of these options are outstanding. So remember, now we have 18,000 options of the 20,000. So we're going to multiply this 175 by 90%. And so the amount of stock compensation expense we're going to go through and recognize is going to be on 12/31/22. We're going to debit stock compensation expense for 157.5, and we're going to credit additional paid-in capital stock options for that same amount. Okay. So if we look at our T account over here for additional paid-in capital stock options, so we've got APIC stock options. We started out with 175. We had a forfeiture, and now we're recording 157.5. So our balance in this account as it relates to the remaining 18,000 stock options is 315,000. Okay. So right over here, it tells us for Titania is that on March 31st, 2023, 12,000 options were exercised when the market price was 40 per share. Don't care about the market price. What I do care about is how much cash am I getting as a result of the exercise of the options. So I'm giving the option price is $25 per share. That's how much I have to pay to exercise it. So over here, this is going to be 3/1/23 or 3/31/23. So the cash that I'm receiving is going to be 12,000 options, and I'm getting a check cut for $25 per share, or $300,000. Now, the next thing I'm going to do is I'm going to credit additional paid-in capital stock options. Now, of these amounts over here, of this 315,000, what's being exercised? Well, 12,000 options of the 18,000 options are being exercised. So over here, if I take 315, because remember 2,000 were forfeited. So this is going to give me 210,000. So over here, I'm going to basically credit to be debit additional paid-in capital stock options. So this is, I need to go through and to take this off of my books. So over here, I'm going to have now common stock at par. Drives me bananas that they use a $10 par value. You would never do that in real life. So we've got 12,000 shares at $10 par value per share. This is 12,000 times 25. This is 315 times 12 divided by 18. This 120,000 is 12,000 times 10. And then our final journal entry over here is going to be what we need to basically go through and do to go through and balance. So right over here, to balance this, I'm going to have additional paid-in capital common stock. I've got 510 of debits, 120 of credits. To balance this out, I'm going to need 390,000. Once I go through and do this, I'm balanced. So over here, this is going to be record exercise of stock options. So after going through and doing this, my additional paid-in capital stock options would be less 210. And that's how we kind of go through and do that particular question. Okay. So I want to thank you for joining me here today. And let me go back to our thank you screen. I want to thank you, Wiley, for allowing me to use the questions and sharing them with you. If you have any questions or if you can help me out on my option quest, I would love to hear about it in the comments below. Have a great day, and I look forward to seeing you on the next video. Have a great one.